This is our second Ask Me Anything Expert Office Hours series. We're so excited about it. We think it's going to be a great offering for so many folks. If you have any topic suggestions for our Ask Me Anything series, or if you're an advisor who's interested in joining us and hosting an Ask Me Anything series webinar with us, please do reach out to me afterwards, and I'm happy to discuss. Before we get started, I just wanted to give a quick reminder about who we are and introduce PCV, if you're not familiar with us. So Pacific Community Ventures is a nonprofit dedicated to the support and the success of small businesses. Our mission is to invest in small businesses, create good jobs for working people, and make markets work for social good. And we do this through our fair and affordable lending program, our free business advising program, and our impact measurement research and consulting program. And more specifically here today, we're doing that through our Ask Me Anything webinar series with Jay, one of our amazing advisors in our network. So Jay Wilson has a passion for empowering new and small businesses, and he has the accounting and tax knowledge and experience, to back it up in order to do just that. He just recently joined the PCV community as a volunteer advisor, and he's already making a huge splash. This entire month, he'll be joining us in hosting what we're calling the Summer of Financial Empowerment webinar series. So along with today, our Ask Me Anything with him today, he's got 3 more presentations planned with us coming up later this month. I've got information on all what's to come at the end that I'll share at the end of today. But for today, we're just so grateful for him to be joining us. And we'll get started. So just before we do, a quick reminder, use that Q&A functionality within Zoom to ask your questions. You can also use the webinar chat functionality as well. And if you're tuning in via Facebook, go ahead and comment there, and we'll be monitoring that as well. So Jay, I'll turn it over to you. I'll stop sharing my screen so you can if you would like to. And thank you so much for joining us.
Well, I'm so happy to be here, and I hope I can impart some knowledge on people that have maybe never taken an accounting course before, never dealt with QuickBooks before, and really don't know anything about how to record so that in the future, or you can tell other people in the future, events that took place either with your business bank account or otherwise. So my goal here today is just to give everyone a little opportunity to get their feet wet with QuickBooks. If they've never done it before, I'm going to go over the basic preliminaries. That said, it might be a little bit slow for people that have used QuickBooks before. I apologize for that. It's really, this lecture, if you will, is going to be for people that have never used QuickBooks before and really know very little to nothing about accounting. I want to be able to give them opportunities to get their transactions recorded using QuickBooks. So let me go ahead and share my screen. And of course, we'll have opportunities for at least 20 minutes, I'm hoping, after I'm done with my lecture here. And then if we need to go over, if they'll give me an opportunity to do that, I'm happy to continue answering questions for people if need be. So I think this is how we do it here. All right. So if everyone will hear me, you're going to see a lot of things on this screen. This is a dummy account that Intuit has graciously allowed us to use for these lectures. It looks like everything's already set up, but the setup process really isn't too bad. What you'll really want to make sure you have before you start using QuickBooks too much is an official business name and a doing business as business name if you want to have them separate. Some people have an official business name that's also their doing business as business name that they use with their customers, and that's perfectly acceptable, especially when you're just starting out. Of course, if you're going to be incorporating, like you want to file the paperwork with the Secretary of State's office to form a limited liability company or an LLC, you will need an official name that is unique and no one else is using. So those are all considerations to keep in mind when you're getting off the ground. The last thing I'd like to recommend is something called an employer identification number with the IRS. It's known in circles as the EIN, and so people will refer to an EIN, and people will often wonder, what is that? It's a unique identifying number for the business. If you don't retrieve one from the IRS website, you'll have to use your Social Security number. So that's why I recommend the EIN and retrieving one before you really get started too much, because that unique identifying number is used in many different ways when you're opening bank accounts, when you're filing tax forms with the IRS. You can use this number instead of having your Social Security number be everywhere to identify your new business. And of course, if you do file that paperwork to become a limited liability entity like an LLC, you'll need to get one of these EIN anyway. So if you haven't done so already, you can apply online. If you just Google IRS EIN, this webpage on the IRS website should pop right up, and you'll click this blue Apply Online Now button and go through the different pages just about, basic information about your business. It's not too bad, and you should be able to get an EIN right away after you fill out the form pages. So enough about that. And the last thing is, if you don't have a business bank account, I recommend just opening a free personal checking account. Use that as your business's checking account, at least until your business gets off the ground after the first year or so. It's perfectly legal to use a personal bank account, or what the bank describes as a personal bank account, for a small business. And it's typically way cheaper than going with the quote unquote business checking accounts that banks offer. So something to keep in mind to keep the cost down, at least initially, when you're first getting off the ground. So once you have your...
Before we continue, there was a question that popped up related to the EIN. I was wondering, could we address that here? Tina let us know that they applied for an EIN over 2 weeks ago, and they told her they were backed up. Any suggestions for that situation?
That might be the case because of COVID. There's going to be a lot of slow-moving parts within the federal agencies because of COVID. My only suggestion is, when you do need to give an identifying number for your business, if you're not an LLC yet, which obviously you wouldn't be able to be without an EIN, just use your social for now, and then you can always move over and start using the EIN once you do receive it. There's really no way to hasten the process with the IRS, so you just need to be patient. It just has to do with COVID, and eventually you'll get it, and once you do, you'll be able to use it. We're about midway through the year, so hopefully, cross my fingers, you won't have to really need one until the end of the year when you start filing your tax forms related to the business. That's really the big opportunity you have to use an EIN. And we have months to go there still for 2020. So hopefully you won't have to use your social in place of the EIN.
Great, thank you.
All right, and so we're just going to go down the list here. On the left-hand side, there's various different options when you first start a company. So as you see, this is our company name here. You can add a picture logo if you want. If you know the basic ins and outs of uploading on the internet, this shouldn't be too big of a problem to get set up and to at least get here. Of course, what you're going to see is no transactions because you won't have entered any transactions yet. So let's go to the banking tab and I just wanted to show how the banking tab works. So here's the banking tab, and as you can see, there's already some checking account, savings account, and a credit card account already set up. So you can set up all these different types of accounts. And as transactions come in, the QuickBooks software will pull the transaction information from the bank's online account. So to set these up, you'll just need your bank credentials, your user ID, and your password from your bank or credit card, if the case may be. And then you can have these transactions come in automatically. Now, something I want to mention is that for every one of these transactions, there's going to be another accounting matching account that we need to match it to. So if, for example, you look at this first one for Amazon, it says that we received $89.99. This business received $89.99 from Amazon on August 7th. So it knows that part of the equation, but we need another account to match that to. Whenever there's an accounting event like money coming from or to a bank account, there's going to be some other account that it affects as well, besides increasing your cash account, which is what the receipt of the $89.99 will do. It'll increase your cash account. So we have this category or match. And so what we're tasked with doing when we're running QuickBooks is matching the correct category for the other account, the account besides the cash account. And so that's what you'll do in this banking tab once the transactions come in. You can link an account here in the upper right corner. And as you can see, it's not going to let me do this, but you'll see that there's a bunch of different banks that you can link, and really all they will really need is your username and password from the bank's website once you've registered your bank account on the bank's website. And other than that, it should be able to pull it in because most bank accounts are compatible. You know, there's some small credit unions and stuff out there that are not. So just bear that in mind. If your bank isn't compatible with QuickBooks, you may need to enter these transactions manually. And that's just more of a process, takes more time. So just as a preliminary measure, make sure your bank is compatible with QuickBooks. That's a good place to start to make sure that we can do this in QuickBooks.
Another question around that came in asking, can I add my personal checking and credit cards to my business QuickBooks account?
So the thing you want to avoid is intermingling. When you have a personal checking account or a personal savings account linked to your business, QuickBooks is going to assume that every transaction coming in and out of those accounts are business related. And it's going to try to categorize them as business transactions, even if they're personal transactions, like you're paying a babysitter or you're buying something at the grocery store. Those things obviously aren't business transactions. So it's good to keep your personal checking and savings account different than your business banking and checking account, unless, like I mentioned earlier, you're opening a duplicate personal account exclusively for using it in your business, then that's of course acceptable. But if you want to use your personal account and you don't feel like opening a second bank account for your business, it will be a headache trying to sift through what's personal and what's business, and you're going to have to deal with that on a daily basis if you go that route. So it's better just to open a second bank account, or a credit card if you prefer. Just something to get the business transactions separate from your personal transactions. That's the goal there. All right, and so like I said, the goal mostly is categorizing our accounts. So we're going to have 2 accounting accounts that's related to every transaction. So the banking account takes care of one side of the equation for us. It's going to either increase the cash account with a received, or it's going to decrease the cash account with a spent. And then we just have to match it to the other accounting account that it's related to. On that note, we're going to dive right into probably the most daunting looking part of QuickBooks, but I wanted to show this to you and get that out of the way so that you can come back to this if need be. This is the chart of accounts. And like I said, at first part, people open this and they say, whoa, this is a lot of stuff. I do not understand any of this. That's perfectly okay. And really, QuickBooks doesn't expect you to understand a lot of this, but it's good to know this right off the bat. It does make it easier when you're going through everything. And if there's a problem, you can always come back to this chart of accounts. Again, it's in the accounting, and you click on chart of accounts here on the left, and it brings up every account that is added in QuickBooks. When you first set up your QuickBooks account, a lot of these are going to be added by default by the software. The software is going to ask you what type of business you have, and based on what you tell the software when you're first setting up your business, you're going to have different accounts that come up automatically, accounts that QuickBooks is guessing you're going to need for your particular business, whether it's a retail inventory business or a service business, etc. It will customize these accounts for you based on the type of business you have. And of course, if there's a special account that you need that QuickBooks didn't think of when it was initially setting up your accounts, you can add a new account here under the new in the upper right-hand corner, and you can add the account from here. And we're gonna add an account here in just a second. So let me get back to that. So a general overview of the type of accounts. So I'm going to assume that no one's taken an accounting class before, and I'm just going to go over the three very general categories of accounts, and it's good to keep this in mind as you're going through QuickBooks. You'll have asset accounts, which are resource accounts. These are arguably the most important type of accounts because these are the resources that you're going to be able to use in the business in the future that you haven't quite used up yet, but you plan to use up for business purposes in the future. So just some examples of those. The easiest example is your checking and savings accounts or your cash accounts. These are money that is ostensibly available to use in the future for your business. And you have accounts receivable. These are the monies owed from your customers. So a good way to think about this is that they're receivable. So they're not received by your company yet from your customers, but they're able to be received. So if you're wondering what receivable means, just remember receivable. It's going to be received in the future from your customers' accounts. And other things, inventory, those are saved up things that you plan to sell to your customers in the future. And we're going to keep an ongoing tally. If you have a retail or inventory type business, we'll keep an ongoing tally of the purchase price of that inventory that you have on hand on any given day. And you have also other different types of accounts. You can, if you prepay to a vendor or a supplier for a particular product or service that you use in your business, then those prepaid subscriptions, et cetera, will also be assets because that's credit that you can then apply towards what your vendor or supplier offers in the future. So if you're in that kind of arrangement with a vendor or supplier, you'd also have that kind of asset. And then the last one for the assets has to do with your fixed assets. And those are fixed because they're going to be used over a long period of time. And there's a special way that we expense those on an ongoing basis. We assume that they're being used by the business. And then this purchase price here on the right, actually, for example, for vehicles, you can see $13,495. That will decrease automatically over time. We make certain assumptions, and then we expense this $13,495 over a long period. We assume that the vehicle is going to be used for a long time. And so these are also assets because, again, they're resources going to be used in the future for the business.
Hey, Jay, we had one question come in about the accounts receivable. They're asking, how does QuickBooks know about receivables?
So you're going to record receivables, and I'll show you all how to do that. It will be under a different tab. It's the sales tab. And there's also another side when you have a bill that comes in. say from a supplier or a vendor. That's the opposite side of the equation. Maybe you haven't paid that bill yet, but it came in the mail and you want to record it in QuickBooks. That's going to be done in the expense tab. And we're going to get to both the expense tab and the sales tab for the accounts receivable here in just a bit when we go over after we go over the different preliminaries on the accounts. All right, so we're at the part where we go over the other two categories, because I said there were three. We've done the asset category, and now we're on to the liability category. Liability is a fancy term for debts. So if you need to pay someone in the future, that's usually because they gave you something, they gave you an asset or a resource. So the easiest way to think about this is when you go to a car dealership, you buy a car, and then in exchange, they impose on you an obligation to pay a loan, right? That's how most people buy cars, unless you have a lot of money. So that said, that's the two different sides of the accounting equation for that particular transaction or event. You have an increase in your vehicle asset if you buy the vehicle for the business. And then you're also going to have an increase in a debt account, or what's called a note account, or a note that you owe to the seller of the vehicle. And that note account will increase by the same amount that your vehicle account increased. You owe the same amount that your vehicle was purchased for. And here we don't have a notes payable until we get all the way down here, and finally you see a notes payable. Notes payable is very common, so they usually will put this in by default. It's a long-term liability, it's a long-term debt, in other words. You're going to be paying it over a long period of time. And when you do make a payment, you'll record that in QuickBooks, and then the payments will decrease this $25,000 amount. So just remember, when you purchase an asset with debt, it will increase the notes payable account or the loans payable account. If it's a shorter term loan that you're going to be paying back, you're going to be increasing those by the same amount. And then as you pay them off, you'll record the payoff amounts in QuickBooks on an ongoing basis to decrease these numbers. And so the liability account or the debt account is one way for businesses to acquire assets or resources. The third category is the last way that businesses can acquire assets or resources. So that makes it a bit easier. There's only two different ways that businesses can acquire assets or resources. They can either take out a loan, or they can take out a future interest in profits for the benefit of a third party. So someone can give you an asset or resource, and in exchange, they expect to take a share of your future profits, if any, that flow from the business. And a good example of this is anyone that buys stock in a corporation. They're giving cash to the corporation, and in exchange, they're getting a piece of paper that says that they are entitled to the future profits in part of the business if there are any profits to be paid out to those shareholders. So again, this means that if an asset account increases, then either a liability account has to increase by that same dollar amount, or an equity account or a shareholder account needs to increase by that same amount. Now, of course, as a new business owner, a small business owner, you're not going to be dealing in stock. So what we'll need to do is create some sort of other equity account when the owner himself or herself puts money into the business coming from their personal bank account, or maybe they take furniture out of their house and they want to use that furniture in the customer waiting area of their business establishment. Those things can be dealt with by creating a special type of equity account that's called the owner's equity account. And what I noticed when I was looking through here yesterday was that there is a couple of different equity accounts here, but what there is not is an owner's equity account. And for a small business owner, that's probably the most important one, because you're not going to be taking out debt for every asset or resource that you need for the business. Oftentimes, you have your own money saved up, your own personal funds, or you have your own personal stuff like that you keep at your house or in storage, and you want to use it in the business. And we need to record it either way, even if it's coming from personal use. So to do this, we're going to track owner's equity in parallel with the asset accounts that are increasing. So let's do this with an example, because I think that that might be the easiest way to explain it without using too many accounting terms. So let's say you, the new business owner, are starting a business with your own money, and you buy a formal living room set for $5,000 to your customer waiting room, and we want to record that that acquisition and make clear in the books that it was purchased with the owner's own money. So I see here that we don't have a owner's equity account yet, and it's an equity type of account, and so we'll click New in the upper right corner here. And for account type, we want to go to Equity, Detail type. We have an option here, Owner's Equity. Now, if you plan on having more than one owner's equity account, like say a husband and a wife are sharing in a small business and they want to keep what was contributed by each person separate, they can always describe it as, you know, Mike or Michelle. You know, you can describe them, and that way you can have separate owner's equity accounts if need be, and you can keep them, you know, completely separate if that's what you choose to do. As co-owners, spouse co-owners. So now that we have our owner's equity account, we can go ahead and save and close, and it should just bring up the owner's equity account now on our list here. And it looks like it does, owner's equity. And so I said that we bought furniture for $5,000. So let's go back to our asset list here. And it's all in order, assets, liabilities, and then equity. So we just need to go back to the general area where the assets are, and we're gonna look for any assets having to do with furniture. It looks like QuickBooks didn't anticipate that we would need a furniture account. So it looks like a furniture account is also something we'll need to add. So we'll click New here in the upper right corner. And it's an asset you're going to use for over a year. So it's ostensibly going to be used for 2 or 3 years at least if it's furniture. So the furniture category should be under fixed assets. And then under detail type, we'll just look for fixed asset furniture. And again, if you want to keep your different furniture types separate, you can say that this is the customer waiting area. Or if you have different rooms in your business establishment, you can describe it differently. Of course, you can even describe it as detailed as the individual pieces of furniture. So if you wanted to put sofa or, you know, lamp, etc., you can even do that if you want to keep all the fixed asset furniture accounts separate. So once we've done that, we have an original cost, and that's $5,000, as I said from our example. And let's imagine we bought it today, so 8/7. And to track depreciation automatically, it's going to make certain assumptions. And it will automatically do this for you. So like I said, the use of the furniture, it's going to assume a certain useful life that is an average useful life for all furniture, and it'll automatically give you a certain expense number that will reduce your profits every year that you use the furniture for the business. And since we don't have any use expense yet, because it's a brand new piece of furniture, we're going to put 0 here, and again, we're going to put 8/7/2020. But like I said, as long as you track this and check this box, the software will automatically look up the useful life for furniture and give you a certain depreciation expense that will reduce your final profit number based on the use of the furniture for any particular period. And usually it's annually. So if we save and close here, we should be at the place where your furniture comes up, and here it is. Fixed asset furniture, $5,000. No depreciation yet because it's a brand new piece of furniture, $0, very good. And so anytime you add a new account, you want to view the register on that account. That will show you both sides of the equation, because you want to make sure that while your assets are increasing by $5,000, you also have the other side of the equation that's also increasing by that $5,000 as I mentioned earlier. So go ahead and click on View Register here. And see, right now I made an assumption to apply it to the opening balance. It's assuming that you're a brand new business. And if you're not a brand new business and you're bringing in the furniture after working in the business for a few months, and you want to add to your business, then we need to change this. And we should be able to change this by clicking Edit. And from this edit category, we see what's called the journal entry. And this is both sides of the equation. We have the original cost of the furniture, $5,000, but it's applying it to opening balance equity, because QuickBooks is assuming that you're opening the business today. So instead, we're going to change this to our new account that we created called Owner's Equity. So we'll change that to Owner's Equity. We'll go ahead and delete that description it did, because that's now erroneous. So we took that out, and now we have the correct journal entry here to record the acquisition of the furniture properly. We have the increase of the asset and also the increase of the owner's equity. So tracking owner's equity, it's essential to know because you want to be able to know when you're spending profits from the business or if you're using your original investment. The goal in the long term is to buy resources or assets for the business with profits that you earn from the business, and not to spend your own money for too long. Of course, in the very beginning, you're going to have to spend your own money for a little while until your business starts making money. But by keeping track of owner's equity, you can return to this account to check on if you have used any of this equity for any kind of supplies or anything you need on an ongoing basis for the business, or if you're using your profits. So that's why it's important to track the owner's equity.
Hey Jay, we have a question that's come in about balancing these journals. They have a specific case that they wanted to run by you. They received a refund by a merchant on a credit card. The credit card sent me a check because I had a negative balance. How would they record this? They say they downloaded the transaction, entered a general journal entry, but am off balanced.
So if you have a credit card that refunded some of your money on a negative credit card, and the credit card is linked to your banking tab here, then when the amount comes in, it should go back to the bank balance on the credit card, and it should reconcile with QuickBooks. The final credit card balance for whatever period the refund took place should reflect the decrease based on that refund. So you're going to reconcile your credit card just like you would reconcile your bank accounts. And I plan on going in the next lecture on, I think it's August 12th, we're going to go over some more fundamentals. And the reconciliation part is a little bit touchy, and there's some nuances there that I want to spend some time on. So I think we'll go over that on August 12th, the reconciliation of the bank accounts and the credit cards. But yeah, that's a reconciliation issue. On a monthly basis, you're going to look at your statements and you're going to make sure that the final balance in QuickBooks matches the bank balance. And since we're in the middle of the month here, as you can see, the QuickBooks balance doesn't quite match the bank balance. But ostensibly, if the credit back to you came out in any given period, then that end of the month statement should show a decrease in the final balance on the card, which then will be reconciled in QuickBooks. So I think that's where the problem would lie, is in the credit cards reconciliation. But I'll go over reconciliation on August 12th. And then remember, if soon after you start your business, you add your own funds to the business's bank account, the automatic bank feed will find that deposit or that money received, just like it will find any other kind of money received. You want to make sure you categorize that kind of deposit or money received as owner's equity. Otherwise, the default is QuickBooks will assume that it's income from a customer. So just make sure you come back to this bank feed if you do make a deposit from your personal bank account to your business bank account. And at this point, we know that all accounts in the accounting belong to three general types. We have the assets or the resources, the liabilities or the debts, or the equity, which again is the interest in future profits. So with that limited knowledge, we should be able to go back to this banking account tab here and start categorizing a little bit. Most transactions in their proper account category will be obvious. For example, you'll look here at Laura's lamination. So you would know as a business owner typically what you spent that money on, and then you can just change the uncategorized expense to the proper expense category that's going to reduce your profits for the month. So if it's lamination, it's likely going to be stationery and printing. So that's good enough. And so this $150 will reduce your net profit for this given month. And it's going to be categorized on your profit and loss statement as stationery and printing. So with the income and the expenses, it's relatively straightforward. Sometimes though, you're not really sure and you need the help of some general patterns and a bit of educated guessing to change the transactions to the proper account here. So some general rules is that any money spent from the bank is going to decrease the cash account. So that's a constant. Any money spent from the bank always decreases the cash account. And it's going to either increase another asset account. So an example of this is buying equipment. You're spending money from the bank account and you're going to increase an asset account. So the category or match will be some type of asset account if you are buying a piece of equipment, let's say. So you can just run up here the list, and of course it's in a different order, but we can put a different kind of asset account here. And just remember, if you don't see the proper asset account here, you'll just add it in the accounting tab under the chart of accounts like we did a little while ago. And if you have if you didn't buy equipment or you didn't buy assets with the money and you instead paid off a loan or spent money from an initial investment from personal money, then it's going to decrease a liability or equity account. So again, money spent from the bank is either going to increase an asset account or it's going to decrease a liability or an equity account, depending on the transaction that took place. And then, as you probably guessed, money received to the bank account. So money that's in this received column is the opposite. Money received is going to increase the cash account. And that's an indication that either there was a decrease in another asset account, like for example, selling a piece of equipment, you'll get the cash from the sale, and then whatever asset you sold is going to be given to expire, and then you'll take that off of your balance sheet or your asset listing. And you'll do that by decreasing that particular asset account, whether it's furniture, equipment, etc. Another way you can receive money to the bank account is by an increase in a liability or an equity account. So if you increase a liability, you're increasing a loan, you're increasing debt. So that's going to be taking out a new loan, for example, which will increase some kind of notes payable, accounts payable, etc. And a good way to look at receivables, as I mentioned earlier, receivables. So you stand to receive it, you're able to receive it, but you haven't received it yet. That's from your customers, receivable. Also payables. If you stand to pay something and you should be paying it, but you haven't paid it yet, that's a payable. So just a little bit of a wordplay there to maybe help you remember what's a receivable and what's a payable, because those are terms that come up a lot, and it's good to know what they mean. Receivables is money you stand to receive from your customers, receivable, and payables is money you stand to pay to someone you owe that is going to collect that money in the future, so a payable. And with this, we need to find out which accounts to match or categorize on the occasion when money was either spent or received. So another thing you'll see is that there are some records. It says 2 records found, and it has this very Las Vegas way of showing you that there's other transactions in QuickBooks that it's matching these bank account transactions to. And we're going to get to these in a minute. That's from the expenses and the sales tab on the left there. So let's say there is some bills or expenses that you're going to pay in the future that'll match to the particular one that was already recorded in the past. So here we see squeaky clean car. You paid with a credit card and you paid it back on July 17th here with your credit card. And this is showing the money spent to pay off that credit card bill that was caused by using your credit card at Squeaky Clean Car. So a couple of things going on, a couple of different processes, but the last part of the process is the money either coming to or from the bank account. Now, to make things a little easier, you really don't need the expenses or the sales tab if you don't have a lot of paper checks or you don't have a lot of bills coming in that you want to keep track of, or maybe you pay with a credit card or debit card, and your customers pay with debit cards and credit cards with Square, etc. And so everything is really immediate. So once you set up your banking and credit card accounts in the banking tab, there really isn't a need to add your expenses or your sales invoices. If you pay for everything immediately with debit or credit, you don't have a lot of paper checks floating out there. You really won't need to spend too much time in expenses or sales. But of course, I'm going to go over those now because oftentimes you want to write checks to vendors or suppliers for a bill that the vendor or supplier sent you, and you want to make a record in QuickBooks of either the bill or the check at either the time the bill came in or the time that you write the check. And even though neither has hit the bank account yet, you want to make a transaction so that it can later be found with this records finding. QuickBooks will match the dollar amount to the date and come up with an educated guess, and the vendor obviously, and make an educated guess on which bank transaction is related to which check or which bill. Again, though, for tax accounting purposes, this isn't really necessary for a small business because the IRS is going to look at just your bank transactions and the money coming in and out. For small businesses, there's a cash basis assumption. And what that means is that when the money comes in or out, that's the year that controls as far as what's going to go onto your tax return. So again, if you don't need checks and you don't keep bills lingering and you don't want to record those in advance, then you don't need to worry about expenses. but we're going to go over the expenses now for the people that need it. So to make a record when vendors send notification, like when you owe them money, so in other words, they mail you or email you a bill, you can add a bill in the expenses tab. So let's click on expenses. And here we can add a bill. And the really important parts of these are the vendor, the date, and the amount. Now you can always add more things if you need to. If this is going to be reimbursed by a particular customer, for example, you can select this checkbox that says billable and then enter the customer from your customer list. And then that will tie this particular bill to the customer so you can get a reminder in QuickBooks, oh, this customer needs to pay you for this particular expense that you incurred while you were doing the particular service for the customer, or you were providing a particular product for the customer. But that's also a little bit more advanced, and you probably don't need that initially for just the ongoing expenses you use in the business. You can just choose a vendor, choose the bill date, choose the due date if the vendor or supplier told you a due date for the bill so that you can make sure to pay it, and then choose the proper accounting category again for the bill. So like I said, since you're spending money, it's either going to be an expense for the ongoing affairs of the business, and those expenses are going to decrease your net profit for the month or the year. Also, you can add assets here for the category in case you spend some money on a big piece of equipment, for example, or some other kind of asset that you're going to use long term. You can categorize it to the proper category here to tie this expenditure to what you bought. And then when the transaction comes in, when you finally do pay the bill with your bank account, QuickBooks will see the bill, and the QuickBooks will match it in the banking tab to the transaction where the money was spent from the bank account. Same thing with checks. So there's another category that says check. So if you write a check to a vendor and the check's floating out there, the vendor or supplier hasn't cashed it yet, you want to put the payee, or in other words, the person you're paying, the vendor. Select the vendor there. When you gave them the check is the payment date. And then the general category, again, what you purchased, so we keep track of that. Either an ongoing expense or an asset. For the most part, those are the general things people buy initially in their business. And then the dollar amount. And feel free to use this description box if you need to. Again, this description box is also optional, but it'll help you keep track on what you bought if you've got a lot of different moving parts. All right, last thing before I want to get to the questions, and it looks like we're running on the noon hour here. So the last thing was the sales tab. And you'll need the sales tab if you don't demand customers pay right away. Maybe you send your customers a bill and you say, pay me in 2 weeks, pay me in a month. Or you have customers that pay over a longer period, like maybe you allow your customer to carry a note and to pay you on an ongoing basis because what you're selling them is something really expensive, for example. You can let your customers pay by check, and you can also take several days to cash each batch of checks. That's another reason why you'd want to use the sales tab here. If the only reason you need the sales tab is not because of invoices where you wait for your customers to pay. Let's say your customers pay immediately, but you do receive checks from your customers. And so the only reason you're going to use this sales tab is because you want to record the checks you're receiving from your customers. You might want to consider mobile deposit using the mobile app of your business bank account. And that way you can mobile deposit all checks as of the end of day you receive them without having to send a big batch of checks to your bank and have them deposit them at the end of the week, for example. With mobile deposit, you can deposit the checks on a daily basis and make sure those are hitting your bank transactions right away, so that we don't have to keep track of customer checks that are floating out there that you haven't deposited yet. So when we're done giving a customer a product or service, we need to give the customer an invoice so they know to pay us, again, if you don't require your customers to pay right away. And so an invoice is something you'll give to the customers. When the customer receives it, the invoice is a bill to them, but to you it's an invoice because you're giving it to the customer. So the business calls a bill an invoice if the business is the one giving out the bill. So it's an invoice on the business side, and on the customer side, it's a bill. And that's the same thing with your suppliers too. If they send you a bill, to them it's going to be called an invoice. To you, it's going to be called a bill. So something to keep in mind. And you can add a new invoice here, again with the screen button on the right. Customer's email. Usually the customer is already in your QuickBooks database. So when you click on a customer, their billing address and everything should pop up automatically. You can set up the particular sales tax if you have to charge sales tax in your state. You can select a proper sales tax here in the bottom right corner. You can add a new jurisdiction, a new state if you need to. And then the terms here, this is just if you give a discount for people paying early. Maybe you tell them they need to pay in a month, but you'll give them a 10% discount. For example, if they pay within 2 weeks instead of a month. If you have that kind of arrangement with your customers, you can use that, or you can just click due on receipt. Most people are just due on receipt. And the rest of this is going to be added. This product service in the inventory tab is where you'll add all these different products or services that you offer to your customers. Inventory and reconciliation, we will go over all of that on the next lecture on August 12th. And then quantity is how much of a particular thing you sold. The rate is how much it cost per unit that was sold. So it'll do the multiplication for you. 20 units at a rate of $5. That means they owe you $100, right? So that's the basics with invoices. And I just have one more thing, and then we'll get to your questions, I promise. And the last thing is, if we click all sales, we'll be able to track the checks. So if a customer, you have an invoice out there and a customer finally pays you, but it's not a payment that hits the bank account. Let's say they pay you with a check. So you want to record the check, but you haven't deposited in your bank account yet. You can click this payment box. You can find the invoice by the invoice number. With the customer will then match to the proper invoice number. And you'll want to leave this as undeposited funds because you haven't deposited yet. And then when you finally do deposit the check from your customer, the bank tab will show money received, and then you'll match this to this received payment on the date that you received the check. And there's all these different options here. This really is only going to be used if you receive a check, because again, if you have all these other ones set up in the banking tab and the transactions are automatically coming in for these other types of accounts, then you shouldn't need to go through this process. So really, banking tab is complete and all set up. You should only need it for checks. And that's all for the very basic preliminaries for people that haven't used QuickBooks before. I'm running up on noon. I was hoping I wouldn't take so long, but of course, you know how that goes. You get sidetracked. Oh, I want to mention something else. So, but I hope that was helpful for people that have never used QuickBooks before. And for people that have questions about things I haven't mentioned, I would like to invite you to the one on August 12th, because we're going to go over inventory and reconciliation, and also reach out to Morgan if you have any other topics you want me to address on the QuickBooks Fundamentals webinar on August 12th, because I'd like to tailor my, lecture, if you will, to what people really are concerned about and really want to know as new business owners. So with that, I'll give it back to Morgan, and we'll go over some more questions if everyone has more time to do that.
Awesome. Yes, thank you so much, Jay. That was awesome. And yes, I know we're coming up to the time, but I think you mentioned you're willing to stay a few minutes after, and so am I. So if anybody on the line has a question, feel free to chat it in the Q&A or the chat box in Zoom. I know we addressed some of yours throughout the presentation, but if there are any last minute questions, please send those in. And I'm just going to share my screen. Just as a reminder, like Jay alluded to, we're going to have QuickBooks Fundamentals, a second QuickBooks presentation with Jay next Wednesday, the 12th. And then he'll be back told 3 more times this month. I'll share these slides out with you all later today, so you can just click on that register right there in order to sign up to join us for those. A reminder, if you haven't used it already, we have PCV's webinar calendar available. Again, this is a link you'll be able to click into once you receive the slides from this presentation. We will share all upcoming webinars from PCV, as well as some of our community partners that we think would be useful for you all. And we also have recordings from previous webinars that you can check out here as well. Finally, here's our contact information from the business advising team here at PCV. If there's anything more we can do to support you at this time, please don't hesitate to reach out. Like Jay mentioned, if there's any suggestions or feedback or topics that you'd like to see us cover, feel free to reach out to me as well. I'm not seeing any last questions. I'll give you another couple of minutes just in case. But otherwise, thank you all for joining us today. Like I said, I'll share the presentation out and as well as a recording. And a special thanks to Jay for spending the time with us here this morning. This was a great first walkthrough, and I'm excited for what's to come next week and the rest of this month. So thank you guys all. Have a good weekend. And if you have any last minute questions, throw them in. We'll be here for the next minute or two.
Have a good day, everybody.
Just going to check our Facebook as well, make sure that there's no questions there. Let me do that real quick. All right. It looks like we're good. Thank you so much, Jay. I'll talk with you next week.
All right. Looking forward to it, Morgan. You have a good rest of your day, too.
You too. Bye.
Bye now.